Hi folks, and welcome back to Meaningful Money. Okay, here I am, still in the park in the shadow of Windsor Castle there, on the skyline. It's starting to get dark actually, you can tell the hour's gone back. Now, we talked about income tax planning last time. Today it's the turn of capital gains tax planning. Planning and just ideas of how to organise your affairs to make the best use of the various exemptions and planning angles that there are around capital gains tax. Now, if you hark back to the video on capital gains tax, which I can't remember the episode number, you'll remember that everybody gets an annual allowance, and that's an amount that you can gain in any one tax year. Excuse me, little itchy nose there. An amount you can gain in any one tax year without paying any capital gains tax at all. So the first thing you should consider is to make the best use of that annual allowance. So it's 10,100 and everybody gets it. So if you have something you are going to dispose of, sell or give away, and remember capital gains tax is charged on essentially the difference between what you sell something for and what you bought it for, loosely, then we need to make use of that allowance. So let's say, for example, you have a whole load of shares. Let's say you conveniently have shares on which you have gained £20,200. Funny that amount, isn't it? Well, logically, you should use your allowance. If you sell those shares and make that gain in one tax year, well, the first 10,100 is going to be tax-free, but the subsequent 10,100 is going to be taxed at the relevant rate. But the logical thing to do would be to sell those shares in two tranches. So you sell one lot in one tax year, one lot in the next tax year, because at the beginning of every tax year, your 10,100 starts again. And so you get one per person per year. So why not make any gains over a period of years, if necessary, to make sure you're making the most of that allowance, rather than just dump the asset in 1 year and pay more tax than is necessary. So use the annual allowance. That's what it's there for. Useful tip for capital gains tax planning is interspousal transfer. So let's say I have these shares, I own them personally, and I have made this gain of £20,200 on them. Well, wouldn't it make sense for me to transfer half of those shares to my good lady wife, who I trust implicitly, transfer them to her, half of them, and then we sell them together. So we use my annual allowance and her annual allowance. Thereby, we can sell the shares tax-free just by moving them between spouses, because there is no tax to pay between spouses. So that's interspousal transfer, useful little planning angle there. Consider also your main residence. If you're lucky enough to have two houses and want to sell one of them, capital gains tax is not chargeable on your main residence. Now, there are definitions as to exactly what that is and various timescales and everything, but you can elect which of your two properties is your main residence. You may remember from the MP's expenses scandal the process of flipping, which simply means electing a different property to be your main residence, then selling it, not paying any capital gains tax. Now, that was rather cynical, and obviously servants of the Crown shouldn't be engaging in that sort of thing where it's cynically done. But it can be a planning tool. Probably a very subtle difference between the two. So just remember, main residence exemption can also be useful in capital gains tax planning if you're lucky enough to have more than one property. Remember also that losses can be offset against gains. So if you do dispose of an asset and lose money on it, you can carry that loss forward, and you can carry it forward for 5 years and 10 months from the end of the tax year in which you make the gain. So I'm speaking to you now in October 2010. So the end of this current tax year is April 2011. Well, I've got if I make a loss in this tax year, I've got 5 years and 10 months that I can carry forward that loss against any future gains. So sometimes it can actually be worth selling something for a loss. Sometimes you just need to dispose of an asset and make a loss no matter what. But that can actually serve you quite well, saving tax if you subsequently sell something else on which there is a gain within that time scale. So losses against gains, useful planning angle there. And finally, you can plan capital gains tax around death, as much as you can plan death, of course. I think it's Dignitas, isn't it? That Zurich clinic where you can plan your death. But the issue is that capital gains dies with you. So if I have gained an asset and it has massively increased in value over my lifetime, well, at the point of my death, that asset passes to my beneficiaries at the value at that point, and their gains start accruing from that value. But any gains, it is not deemed that the deceased person has disposed of it. So there's no capital gains on me, the deceased, and my beneficiaries start accruing their own capital gains from that point. So, useful thing to know, capital gains dies with you. Maybe it's worth giving something away to a loved one or whatever on death, rather than giving away during your lifetime. Of course, inheritance tax might apply, but that's the subject for next video. So just a few little capital gains tax planning angles there. Hope they're useful. It's going to be the last one from Windsor. I feel kind of exposed speaking to you from the big city. I'm kind of itching actually to get back to my little peninsula down in West Cornwall. Lots of weird people walking around, but they probably think the same about me talking to a matchbox-sized camera. So thanks for watching, and I'll see you next time.